Good afternoon, folks. Thank you so much for joining us this afternoon. I am Alan Barr, a partner and head of personal tax planning at Brodie's. I'm delighted to welcome you to this seminar of our analysis of yesterday's budget. We hope you find the session useful. As I say, I'm Alan Barr. We have speaking this afternoon Karen Davidson, who's our corporate tax partner, Isobel, our director of corporate tax, Neil Ritchie, our director of personal tax, and a very special guest who we're delighted to have with us, Stuart Patrick, CBE, the chief executive of Glasgow Chamber of Commerce. Stuart will be pitching in on this with some non-absolute tax points, because the budget itself, of course, was not by any means all to do with tax. It was, it may be fair to say, an innovating event. It was a big day. I had a very big day yesterday. I had my first vaccination at just about the same time as Mr. Sunak was getting to his feet for his second budget, and it brought back memories, of course, of his first budget, which is just under a year ago, and it is interesting to remember how absolutely different things were at that time. The weather was just starting to be beautiful. It was literally the week before things got very, very serious indeed. And when he was giving his first budget, he could hardly know that it would influence, that what was happening around him would mean that the first budget became pretty well irrelevant for many reasons after it had been given, and the next budget that he was able to give would have to cope with an entirely unprecedented set of circumstances. We are circulating a detailed note on the budget with some analysis of a lot of things. You should receive it and contact to it by email in the near future in any event. This afternoon, we're going to be picking out certain aspects that we consider the most important of the tax elements, plus, as I say, one or two other elements in the course of the afternoon. The budget, of course, followed the Scottish budget, and that is something we will focus on a little, because for taxpayers in Scotland, or Scottish taxpayers, not necessarily the same thing, things are a little different. And one of the things that was different is that things were set for Scottish taxpayers in the Scottish budget, as far as income tax goes, in advance of the UK budget. As things turned out, I don't think there'll have to be dramatic changes in what was set then, but it is a factor that has to be taken into account. But I think it's fair to say that the main focus, both now and in the medium term, was on business taxes and indeed business support, and to some degree individual support. And that then is going to form our first subject, in that Karen Davidson is going to look at some of the main business tax changes, and I shall pass you over to Karen now.
Thanks for that, Alan. Yes, so we're going to look at the main themes for businesses, and particularly corporates, from Ritchie's announcements yesterday. So he had widely trailed his strategy of giving support to business now, but paying for it later. So I think we would all recognise that we'd been expecting the rate of corporation tax to increase. But the increase in the main rate to 25%, which was announced yesterday, was definitely at the top end of what was expected. This new tax rate is expected to raise around £17 billion a year, and it's clear that corporate UK is going to be expected to shoulder a significant portion of the burden of this pandemic. The new rate marks a really significant shift in Conservative Party tax policy. We're pretty much seeing a 180-degree turn on corporation tax rates, which have fallen over successive parliaments from 28% in 2010 to the current rate of 19%. We didn't ever quite reach the 17% target that the government had originally headed for, but here we are now bouncing back up to a main rate of 25%. It's not happening straight away, and it won't apply to all businesses, but it'll apply to some from the 1st of April 2023. Whether that is a tax hike that's so significant to put off inward investment into the UK really remains to be seen. Sunak yesterday was very keen to point out the competitiveness of that headline rate compared to the rest of the G7. We were at the lower end of the G20 group for headline rates, and here we are now shifting towards the middle of that G20 group. But it's not quite as simple as that. The headline rate is really only one part of the tax jigsaw for businesses, and the extent to which allowances and deductions are included, you really need to factor in too. And with recent changes that have been to deductibility of corporate interest in the form of the corporate interest restriction regime and restriction on carry forward losses for corporates have really impacted on the UK's tax competitiveness. So with this new tax hike, it will be interesting to see how that plays out. Certainly, the impact of multinationals shifting profit out of the UK has been factored into the costings. So the government has acknowledged that there will be expected to be some behavioural impact. So the move now sees the reintroduction of the small profits rate, which we have seen before. This time it's at 19%. So for companies with profits below £50,000, they will continue to pay tax at the current rate. That £50,000 threshold is significantly below the previous threshold for the small profits rate, which used to be £300,000 back in the day. And so the main new rate should only really apply to around 10% of companies, I think is the estimation. 1.5 million smaller companies should escape that higher rate. These new small profits rates should exclude close investment holding companies. My colleague Neil will talk more about that later. And we are expecting to see some associated company rules, which were previously the case with the small profits rate, just to prevent companies from fragmenting their profits and manipulating the system to try and get into the new lower rate. And for companies that fall between that small profits rate of £50,000 and the main rate of £250,000, they will be able to claim marginal relief from the main rate. And that should result in a progressive effective rate increase up to the 25% rate when they hit that £250,000 level. Again, that threshold of £250,000 is significantly lower than the £1.5 million threshold, which used to apply to marginal rate relief. We don't have any specific details yet on how that marginal relief will apply, but I think we can assume that it will follow broadly the previous regime, and if that's the case, then no doubt we're all going to have some calculation headaches to come, which will be reminiscent of the past. And just noting there that there will be an increase in the diverted profits tax up to 31% to keep that 6% differential. So on the next slide, the previous slide was the pay later for corporates, but what we have here is the spend now measure that Ritchie announced. And what has been announced was a super deduction for investment in new plant and machinery. This was something of a surprise, but it's quite a neat trick for stimulating early investment by those companies that have got the firepower to do it. And Rishi Sunak is obviously hoping to use it as a means to stimulate the economy in the short term. It's great news for capital intensive industries such as manufacturing and construction. So the super deduction is going to operate as a first year capital allowance of 130%, which is used against taxable profits. And it will be available for investment in new qualifying plant and machinery, the sort of plant and machinery which is currently entitled to the 18% main pool writing down allowances. It applies for expenditure incurred between 1st of April 2021 and April 2023, so it's only going to apply for 2 years, and you need to have contracted for that expenditure after yesterday. Given that it's only going to be available for the next 2 years, then clearly it's only going to be able to be used against the current 19% rate rather than being available for the 25% rate in the future, save where you're dealing with carry forward losses. The other interesting thing to note is that it's only available to companies. So whilst other unincorporated businesses are entitled to capital allowances, they're not going to be entitled to this super deduction. They will have to make do with the currently available annual investment allowance, which is itself being extended for a further year at its current £1 million level, up from 200,000, and that level will last now until December 2021. A 50% deduction will be available for new investment in special rate pool plant and machinery or integral features. As ever, with the super deduction, the devil is in the detail. So not all assets are going to qualify. So just as by way of example, cars or connected party transactions and expenditure on assets for leasing will not apply. So you'll need to carefully look through the qualifying expenditure to make sure that your spend is definitely going to apply. As I said earlier, the new super deduction will cease before this new 25% rate comes in. So businesses that are anticipating capital expenditure are going to need to model carefully the merits of accelerating any spending plans to take account of the super deduction being available against profits that are currently taxed at a lower rate, and also taking into account the restrictions on carry forward losses that we're now living with. Clearly, when we get to 2023, the government at that stage is going to need to adjust any tax measures to remain sensitive to the economic performance of the UK at that point. So it will be interesting to see whether the super deduction might last beyond the initial 2-year period in the way that the temporary increase in the annual investment allowance has been extended. So if we move on to the next slide. In recognition of the current economic situation that many businesses are currently finding themselves in, there's going to be an extension to the current carryback rules for loss relief, and this will apply to both incorporated and unincorporated businesses. The new rules will allow up to £4 million worth of additional carryback of trading losses, which are incurred over the current tax year and the next tax year. And that will be able to be carried back over an extended 3-year period, utilised against profit in the most recent years first. Claims for the extension are limited to £2 million per tax year. So those will be restricted when they are set off against the earliest 2 years in that 3-year period. This loss relief carryback is an increase to the current 1-year carryback rule for corporates that currently exists. But you should note that those claims, so those that are only going one back, can be made without any cap, so they won't be subject to that £2 million cap. And it's also interesting to note that there's not going to be any prorating of that £2 million cap if the relevant accounting period happens to be shorter than 12 months. So for companies, this could result in up to an additional £760,000 worth of cash repayment if they're able to make maximum use of this extended relief. And amounts could actually be greater for large unincorporated businesses, given the difference in tax rates. So this could be a significant cash boon for those that have companies that have been previously profitable, but have been especially hit hard by the pandemic. There are going to be some special rules created for corporate groups. Those groups with companies that have extended loss carryback amounts in excess of £200,000 will be limited to a group-wide cap of £2 million. But there's no cap for groups where no one company has losses in excess of that de minimis threshold. And it's also worth noting that if you have already made some group relief claims, these new rules cannot displace those previously made claims. Similar rules apply for unincorporated businesses, although the interaction of the extension with the current loss relief rules is slightly different just because of the differing tax regime. The rules apply to trading businesses, but also apply to professions and vocations. And interestingly, there's no partnership cap, which is similar to the group cap for corporation tax. So for both corporates and unincorporated businesses, there are going to be time limits for making these claims. For corporates, that will be 2 years after the relevant accounting period for companies has ended. And for unincorporated businesses, a claim needs to be made by January 2023 for the current tax year, and then January 2024 for the subsequent tax year. For corporation tax losses that are below that de minimis 200,000 cap, you don't actually need to make a claim through your tax return in order to access the relief, so long as the loss has been established and you've reached the end of your relevant accounting period. So that might actually allow for an earlier unlocking of this cash for some cash-strapped businesses. For unincorporated businesses, the claims will generally be made through self-assessment returns, other than where the claims are being carried back over more than one tax year. So it raises an interesting calculation for companies who are likely to fall into the 25% mean corporation tax rate should they carry back, given that that generates cash now, but at potentially against a lower tax rate than carry forward reliefs might give them benefit for, albeit the ability to carry forward has been restricted by recent loss relief restrictions. So some careful modelling might need to be taken into account to work out the best use of those losses. And if we just move on to the next slide, there were a handful of other changes that I think are worthy of mention that are highlighted on this slide. Picking a few of those, the government announced a change from the 1st of June this year to the way in which withholding tax on interest and royalty payments made to companies within the EU will be taxed. So previously there was an EU interest and royalties directive which had been enacted into UK legislation, and that provided a 0% withholding tax on payments of interest to other to companies in EU countries. Post-Brexit, this legislation is now being amended. So for those that are paying interest and royalties within the EU, they're going to need to check the relevant double tax treaty provisions and make appropriate claims for relief. For most double tax treaties within the EU countries, there is already a 0% withholding rate, not all, but most. So rather than being a significant revenue generating opportunity, this does seem to have been a bit of a flag wave by the UK government in relation to its position post-Brexit. The government has also announced a new consultation into the two R&D relief schemes, and this is in line with their general announcement of a specific aim to increase R&D expenditure to 2.4% of GDP by 2027. Without wishing to steal the thunder of any of my colleagues who are speaking later in the session, the notable absence of any indication of an increase in capital gains tax does mean that share incentive arrangements are still in the corporate toolkit for employee incentivisation. And for EMI schemes, there has been an extension to the working time requirement relaxation until the 5th of April 2022 to deal with those people who are on furlough. And the announcement of a consultation on how to make EMI legislation more fit for purpose and targeted at the right companies and hopefully less complicated will be very welcome. Some technical changes to hybrid mismatch rules I will not go into today, and there were some technical changes to corporation tax loss relief, which were also announced, and no respite for businesses grappling with the introduction of the new payroll worker tax regime. That will still go ahead, albeit with some minor changes to take account of some changes which were required to make the legislation work as intended, all of which had been trailed prior to the budget. So I will now pass on to Stuart, who will put all of this into context for Scottish business.
Thank you very much. And let me just give you a sense really of where we thought we would like the budget to go as a British Chambers of Commerce movement and whether we got what we wanted in the budget yesterday. So I'm just going to pick out a few of the items that we had lobbied for and give you a flavour of what we think we received in return. First up was a request for additional cash grant support for retail, hospitality, leisure businesses, and we were asking for anything up to £25,000 to go to those businesses as a reflection of the overhead costs that JRS was not able to cover for obvious reasons. We got in return the Restart Grant Scheme, which in England will give cash grants up to about 18,000 for retail, hospitality, accommodation, leisure, and interestingly, personal care as well, plus 6,000 for non-essential retail. Now, of course, in Scotland, it will depend on what the Scottish Government decides to do with the Barnett consequentials, and it was made quite clear in the budget statement there is £1.2 billion of consequentials that will fall to the Scottish Government, who will now decide whether they will broadly replicate that cash grant scheme. They have already said that they were going to continue the strategic framework for business funding that allows for the monthly cash grants to go out to the heavily affected businesses, but we now wait for the detail of whether that will go out in the format that is similar to what the Chancellor has just announced. The second item was the recovery loan scheme that we were asking for, which was asking for extensions of the existing government lending schemes, such as CBILS and business bounce back loans. And we were also asking for exit strategies around how to deal with the high debt burdens that particularly SMEs have taken on during the crisis. We already had announcements about the extension of both business bounce back loan repayments from 6 years to 10 years. CBILS was more in the hands of the banks, but what we got was this recovery loan scheme, which now offers a new scheme opening after the end of March, and which will provide government guarantees of 80% on eligible loans between 25,000 and 10 million. Interesting to hear from Karen on the extent of carryback on losses, is the extent of whether that will help some of the companies that have built up their debt burdens to try to offset that to a certain extent by getting cash back on previous tax payments on profits. But I haven't actually seen the amount of money that the Treasury thinks that might cost them. So I'm not sure whether that will offset somewhere between 70 billion to 100 billion of lending that companies have taken on that the city thinks is quite difficult for them to repay. The third thing that we were asking for was extension of business rates relief. And we already in Scotland had the announcement last week that business rates relief for retail, hospitality, leisure and aviation was going to go through to the end of this next financial year. The Chancellor offered up the business rates holidays for retail, hospitality and leisure for the period up to the end of June, and then a discount thereafter for the rest of that financial year. Again, we would expect that the 1.2 billion will be getting used by the Scottish Government to cover the costs of those of that rates relief. So it'll be interesting to see what else the government then decides to do. Does it use that that extra money to deploy for some other purpose? The fourth thing we asked was job retention scheme, obviously extension. We asked for it to be extended to at least the end of July, but for as long as companies were affected by restrictions. And arguably we got that. We got the end of July unaffected, but we got the reintroduction of employer contributions after July. I won't go into the details of that. I know that's coming later, but that clearly puts under the Scottish Government under some pressure, because we do not as yet have a particularly well fleshed out roadmap out of the restrictions, which will confirm in our mind whether the closure, the gradual closure of the job retention scheme and the gradual reopening of the Scottish economy will be matched. So that's going to be a particularly important issue for us to be lobbying with Scottish Government in the weeks and months ahead. Our fifth ask was equally extension of the self-employment income support scheme, and we got that with 2 further grants being offered for February to April and from May to September. And we also were pleased to see that 600,000 estimated applicants for newly self-employed will get support now that they previously weren't getting. Our sixth ask had been on annual investment allowances. We were asking for an increase in the annual investment allowance, and boy, we got that with the super deduction. Clearly, we are as interested as everyone else in the eligibility of the assets covered by super deduction, and clearly also want to understand, especially in a predominantly service sector economy, just how much service sector companies will be able to qualify, if at all. The pitch on this is clear that we have a very poor track record on business investment comparatively internationally, Obviously, a super deduction is designed to try and address that. Is that going to be enough to offset a long track record of underinvestment in business, especially since corporate taxes will be going up, as Karen was describing, in 2023. So I know we're going to have a fierce old debate about whether the balance of that was right or not. Seventh asked, we asked for a temporary Brexit costs tax credit. And I know that was a bit cheeky, really, if you're asking this current government for that. And sure enough, of course, we didn't get it. But we did get in response a couple of potentially interesting schemes. One was the 375 million UK-wide notable Future Fund Breakthrough Scheme for innovative companies, and also a Help to Grow scheme, which is estimated by the government to be about to reach 130,000 companies to assist in digital pivoting and in improving management capability. So we look forward to seeing how that will play out in detail. But again, interesting to see that these are UK-wide schemes that we might argue we're cutting across some of the areas that would otherwise have been regarded as reserved powers. And eighth in our ask was that we saw the details on shared prosperity funding that was replacing EU structural funds. We got the beginnings of that with the launch of a temporary scheme called the Community Renewal Fund. It's a relatively small scheme at this stage. 225 million, I think, was set aside for that. It was allocated to 100 different local authorities who will be able to bid in directly, and there are local authorities in Scotland that will be able to do that. Ayrshire, Lanarkshire, Falkirk, Glasgow, for example, are all eligible, and they will be in a position to make applications for projects that will support skills, will support business growth, and will support community development in a variety of forms. So that in itself is an interesting one. I know it's highly political because of the direct support going to local authorities rather than through the Scottish Government. And we can expect, I suspect, considerably more of that when the Shared Prosperity Fund is finalised for the next financial year after the one forthcoming. We also got a couple of announcements. Well, one additional announcement I think is very relevant in the Scottish context was the allocation of free ports to 8 different territories in England. We are due at least one free port, or in the Scottish Government terms, a green port in Scotland. We are waiting to see now whether the Scottish Government and the UK Government can come to agreement about the 2 different approaches, free ports versus green ports. I won't go into the detail of that, but certainly from the perspective of, say, in my bailiwick, the idea that Liverpool has now got a free port and potentially the Clyde doesn't is a somewhat serious concern. So we are keen to see at least one, hopefully 2 free ports coming through for Scotland in due course. But completely separate to the budget, just to finish, completely separate to the budget was today's extremely welcome announcement that whisky tariffs have been suspended for 4 months by the US as further negotiations continue on a permanent solution for that industry. And I'll stop at that. I will hand over to Isobel to go into much more detail on some of those and other points.
I'm just trying to unmute myself. I think I've managed.
I just sprung in, sorry, Isobel, just for 1 second, just to encourage people at this halfway point, do please use the question and answer function. We've got 1 or 2. We'd like to see a lot to give us a choice of ones to answer. If you can come in on things we're talking about or things we're not talking about, we'd be delighted to try and answer them. Thanks, folks. Sorry, Isobel.
No problem. Afternoon, everyone. Picking up a few points that Stuart mentioned, obviously this budget was well trailed in the press and elsewhere, and as expected, the furlough scheme extended to September, but with the return of employer contributions. And as time goes by, the challenges of the devolved tax and devolved systems making their presence felt in relation to funding, being different in the UK and the roadmap out of the coronavirus also being different. So the extension to the furlough schemes, there are various requirements as to when people were on the payroll and so on, but it's broadly as people expected, and astonishing to think that it's been going on for so long. On the self-employed income support scheme, there's a 4th grant and a 5th grant which have been announced. 80% of trading profits for the 4th one, and a maximum of 7.5 grand. And the 5th one is dependent on how much profits have fallen by. So if they've fallen by 30%, then it's the full 80%. If not, it's a 30% grant. So newly self-employed also included, as people will remember, that's one of the issues that caused a lot of consternation, that because they had to introduce a starting point, a lot of people effectively missed out. Moving on to the next slide, I think the next slide talks about the SDLT holiday. So the SDLT holiday, which is an increase in the nil rate band to 500,000, has been extended to 30th of June. And again, that was fairly widely trailed, but there's also a follow-on period from July to September where the nil rate band is 250k, which is twice its normal rate, and it reverts back to 125 from 1st October. This is a different approach to the position in Scotland. In the Scottish budget on the 28th of January, there was confirmation that the Scottish equivalent stamp duty holiday wasn't being extended. So the nil rate band for Scotland will return to its normal level on the 31st of March 2021. In Scotland, there were record LBTT receipts in December last year of over 82 million pounds, and that could be the explanation for the fact that the stamp duty holiday hasn't been increased. However, it's very interesting to note that yesterday the Welsh government extended their equivalent holiday for the land transaction tax. So England and Wales taking a different approach from Scotland here. Will Scotland do anything about it? Moving on to a couple of other points on SDLT. There's a 2% surcharge, which has been well known about for the purchase of residential land by non-residents and by companies controlled by non-residents in England. There is no equivalent surcharge for LBTT in Scotland. We do actually have a higher rate of the residential surcharge anyway, at 4% here compared to 3% in England. However, this surcharge will make quite a difference for a lot of purchases, particularly the companies controlled by non-residents, which probably isn't widely understood that it can have an effect there. Free ports have been mentioned, or green ports, and these are quite a departure for the UK, and we've not really had anything like this before, and they are sort of tax advantaged areas. So there'll be an SDLT complete relief for the purchase of land in free ports, although not for leasing of land. And that'll apply for purchases from the date the free ports are designated, which I believe is the 9th of March, until 2026. You have to buy the land for a qualifying use, and there's a 3-year control period during which time HMRC can check up that it is being used for the proper purpose. In addition to the SDLT relief, there's 100% capital allowances available in these Freeport areas. And we're expecting that if and when a Freeport or Greenport is set up in Scotland, there'll be an equivalent LBTT relief, but obviously that forms part of the discussions with the devolved administrations that's going on at the minute. Moving on to the next slide, the VAT reduction in rate to 5% has been extended until the end of September. Then it will rise to 12.5% and then to 20%. So there'll be quite a lot of bookkeeping headaches in terms of keeping track of all that, but nevertheless, very welcome measure. And those people who deferred VAT payments until the 31st of March 2021 can now sign up to pay these as installments, and the sooner you sign up, the more installments you can get. So that again will be a welcome cash flow development for many people. There were no other changes to VAT, to the rate or what zero rates apply to and so on, although it's worth bearing in mind that as a result of Brexit, these things can now happen in a way that they couldn't do when we were part of the EU. And the repeal of the Interest and Royalties Directive, which Karen mentioned earlier, demonstrates that the government is not afraid of departing from the EU position. Just another point to bear in mind, although it's probably one of these things that will never happen, is that because we're now out of the EU, VAT could be devolved to Scotland, which was not possible before, but I think that might be a bit of a tough nut to crack. So I think I'm handing over now to Neil to talk about income tax.
Thank you, Isobel. These were the people who had something very positive to tell you. We now move to the part of today's discussion about all things relatively frozen, and nevertheless, there are some quite interesting implications as a result of these, which hopefully we can draw upon and explain a little. Income tax, the rates have been frozen until 2026. It's worth bearing in mind that in the Tory manifesto, they pledged not to increase income tax, national insurance, or VAT, and so their hands were a little tied because of that. So rather than increase rates, they have frozen thresholds instead. So they had already indicated that they were going to raise the 21-22 threshold in line with CPI. So they've gone ahead, they've done that, but thereafter they have frozen the threshold from 21-22. That will remain the threshold through to 25-26. And with that, we obviously get quite the potential of some fiscal drag, depending on how inflation goes from here until then. One of the interesting things about that, though, is that it relates to the NIC, where we have relatively recently aligned the income tax and the NIC thresholds. But by freezing the thresholds for income tax, if the NIC thresholds remain aligned, then we will be freezing the revenues from NIC. So it's unclear, it's probably unlikely, but it's unclear as to whether the thresholds for NIC may increase going forward or not. However, before we leave income tax, I think it's worth looking at the difference in the tax rates suffered by a Scottish taxpayer relative to the rest of the UK taxpayer. The starting point on this slide is the 27,393. That is the tipping point where it's cost the same tax-wise for somebody to live in Scotland as it does in the rest of the UK. Beneath that, it's cheaper to live in Scotland. Above that, it's more expensive to live in Scotland from an income tax perspective. The next point, 43,662, that is the start of the Scottish higher rate band. And so you'll see at this point that there's really very little difference between Scottish and the rest of the UK, with just £163, which represents 0.37% of an increased tax charge on Scottish taxpayers. However, over that, from 43,662 to 50,270, Scottish taxpayers are paying 41% tax, whilst the rest of the UK taxpayers are only suffering 20%. So quite a significant increase. And as a result, at the end of that band, there is a £1,550 difference, effectively an additional 3% tax paid by Scottish taxpayers. The next band is the band starting from 100,000 up to 125,140, during which our personal allowances are eroded. Now, the tax rate there is 41%, but because you are losing £1 of personal allowance for every £2 of income, you effectively add 50% of the marginal rate, 41%. So half of that is 20.5. So you are paying 61.5% through that threshold, versus the rest of the UK, which is 60%. So we're now a 1.5% differential there, and you'll see again a jump from 2.05% up to 2.69%, relatively speaking. So again, another jump up in Scotland. That then moves us all the way on to 150,000, which is shall we say, the most expensive in terms of percentage of earnings for Scottish taxpayers. At that point, there is a difference of £4,856, or 3% additional tax, 3.24% additional tax on Scottish taxpayers. And just for interest, you'll see I put in a 250,000. By then you're almost hitting £6,000 of a difference, but as a percentage of earnings, that's dropped now to 2.34. So just putting into some figures to give you a sense of the Scottish tax differential. So just moving on then, I wanted to go back to talk about some of the corporation tax rates, just from an individual's perspective, rather than the corporate perspective, which Karen provided earlier. Just to touch upon the marginal rates between profits of 50,000 and 250,000 in particular, that is, you're 19% below that and you're 25% above that. But actually, in this band between 50 and 250,000, that is actually where you are suffering the most amount of tax, as you sort of move from 19 to 25%. And what you have to remember is that many owner-managed businesses like to pay themselves with dividends, or have done up until COVID and the problems that may have created for them. But of course, dividends are not deductible for corporation tax purposes. So if somebody chooses to instead pay themselves a salary, even if it's some salary of 20 or 30,000, to manipulate their profits down from 80,000 down to 50,000, then that potentially achieves it. The other thought is that there are a lot of director loan accounts provided, some of them interest-free, and maybe now is the time to start thinking about charging interest on these directors' loan accounts, and as a result, that interest is deductible for corporation tax purposes, and would be a very effective way of getting cash out of a business without paying the employees or the employers A&I. And the last thing I wanted to talk about is family investment companies, because they are the close investment holding companies that Karen mentioned earlier. They therefore are subject to corporation tax rates at 25%, even if their profits are below 250,000. However, does that mean the end for family investment companies? Well, dividends remain subject to no tax in a company. So to that end, family investment company is invested in equities, then there is no implications. Normally, most portfolios will have some degree of interest. That interest would be subject to 25%. However, it can be offset by deductions for the management, investment management costs, accountancy fees, tax fees, and the like. So there are deductions that probably in a balanced portfolio of that favours equities, there's probably sufficient deduction to offset the interest. That, though, leaves capital gains tax, and so capital gains would be subject to tax at 25%. But finally, just mentioning rental or property companies, while they are investment companies, they have an exemption from this, so they would not be caught, provided the properties are let commercially to third parties. If they are let to connected parties, connected people, then that would not be covered by the exemption, and that would be subject to 25%. So just one or two additional thoughts from the individual's perspective on corporation tax rates. And with that, I will hand back to Alan Barr.
Thanks very much, Neil. Before we draw things to a conclusion and try and answer one or two questions, I just want to say a couple of things about, frankly, dogs that didn't bark. Because among the most pervasive rumours of what might happen in this year's budget was that capital gains tax rates were going to rise, perhaps even, as has been the case in one time in the past, another blast from the past, simply to be treated as the top part of income of taxpayers. Now, that didn't happen, and indeed nothing happened. The capital gains tax annual exempt amount was frozen, but there was no sign yet, and I'm using that word deliberately, of changes to capital gains tax. The reason for the yet is something that may bring a great deal more. 23rd March has been marked down in tax nerds' diaries as consultation day. On that day, the HMRC and the Treasury have threatened, promised to launch a number of consultations on frankly, it could be on anything, but on possible structural changes to a great deal of the tax system. And one of the subjects, I think, is almost certain to be capital gains tax. There have been two recent reports from that great oxymoron, the Office of Tax Simplification, on capital gains tax, or at least including capital gains tax. And I think that there will be, at the very least, further consultation on it. What, of course, it meant is that people who rushed around, and I was one of them, in relation to some clients, to get things done before budget day in fear of an immediate change to capital gains tax rates, well, that was to some extent wasted effort, except that it meant that things that probably should have been done anyway were done just a bit more quickly than they actually ended up needing to be. And on a similar note, I would just like to mention inheritance tax. There is nothing to see here except that to an even greater extent than we have mentioned already, there is an effective tax rise because the nil rate ban for inheritance tax is to be frozen, not just for the next year or two, but right through until 2025-26. And this has been frozen, this main nil rate ban for inheritance tax, since 2009. And that freezer, as it were, has been turned up each and every year since then. And what that illustrates, as indeed do several of the changes that Neil in particular has mentioned, but actually have occurred in quite a number of aspects of the tax system this year, is fiscal drag. Fiscal drag, the cloak of fiscal drag, conceals tax rises. And there's a kind of further supreme irony in this, because if we have the kind of economic recovery that people are thinking of, such that, for example, wages go up, estates rise in value, even kicking into values of things like houses and shares, then the effect of freezing these allowances is a very real tax increase. So it is not to be understated. It means that the government was able to stick to manifesto pledges on income tax, for example, on national insurance, on VAT, of not raising rates. Well, that's been just about right. They haven't raised rates, but the process of fiscal drag in relation to income tax and in relation to inheritance tax are effectively tax rises by any other name. Okay, that concludes, and I'm pleased to say, just about when we intended to, what we were dealing with individually. We are all, I think, now coming back together, and we're going to attempt to answer some of the questions that we've got in. I am going to turn immediately to Stuart for the first one, if I may, or primarily for Stuart. Others may have views. And the question is for everybody: to what extent could the proposed English free ports result in the devolved economies, including the Scottish economy, being placed at a competitive disadvantage, at least in the short or medium term? And perhaps you might want to just say, you know, views on free ports generally, if for example, we were to get one in Scotland, Stuart.
Yeah, sure. I guess in essence, the Scottish government answered the question about potential competitive disadvantage with its own doubts about whether free ports were a good idea, because their own argument has been that they are largely displacing. They simply reallocate investments from one part of a country to another part of the country, and that is because of the tax incentives, planning incentives, whatever incentives are packaged up with a free port. And I'm not the best person to answer what those packaged incentives are actually going to be. But clearly, from our perspective, if I look at Liverpool and I see a free port in action, I immediately go and ask Clydeport, what sort of impact might that have on your business? To which the answer was, yes, that could be quite severe. It could actually move quite a bit of logistics business away from the ports on the Clyde to Liverpool, and a variety of investments that go alongside the logistics of those ports. But it may also actually encourage, it's not always related to the port. Some of the investment could simply be taking advantage of some of the capital allowances and so forth that are allowed in a free port. So yeah, it's potentially a competitive disadvantage. If you throw in HS2 connections to Manchester and the likelihood of that being delivered, and you understand that the Northwest is already faster growing in its inward investment competitiveness recently than Scotland. Scotland's always been number 2 after London, but the Northwest has been catching up at some pace year on year. Throw in those kinds of investments and we don't have them, then yeah, that's a worry.
Okay, thanks very much, Stuart. We think that the Scottish devolved administration is engaging very seriously with this. I think Greenport is what it's going to be named rather than Freeport. But I think you're absolutely right that, you know, if it were just on either side of the country, Liverpool and Teesside, that's not many miles below it's their Scottish equivalent. Thank you. A short one, I think, for Karen, which is, did the Chancellor indicate any revisions to entrepreneurial tax relief? I'm presuming that refers to actual entrepreneurs relief as was, business asset disposal relief as now is, but you might just take the opportunity to mention anything on any similar ones that you'd like to mention.
So I guess this is in line with your comments, Alan, on capital gains tax generally. We were all expecting some changes to capital gains tax to be announced, if not now, then certainly later. So I think Entrepreneurs Relief, or as it's now called, Business Assets Disposal Relief, which is always a bit of a mouthful, isn't it? It is very much in that camp. I think we can expect to see something along those lines in the consultations alongside the rest of capital gains tax. But again, you know, it will sit in line also with the consultation on EMI options, which obviously automatically get into business assets disposal relief in relation to their shares. So there's a lot of kind of interconnecting factors that I suspect will take place within the consultation period.
Thanks very much, Karen. Next question we're asked is somebody noticing some deferral for VAT. Is there any deferral for payment on account in respect of self-assessment tax? So, Isobel, perhaps you could just say a little about the VAT deferral, which struck me as inordinately complicated, but nonetheless useful. And then perhaps Neil, any answer? Is there any deferral of self-assessment tax? Perhaps it's fair to say further deferral as compared to last year. Isobel, on the VAT deferral.
Yeah, so on the VAT deferral, I think it's a question of deferring payments. I think there's a maximum of 11 that you can get, but it's really just a question of when you apply for the deferral as to how far you can stretch out the payments. But the best thing to do is to go onto the portal that's now available, and you know, as soon as possible, in order to set up the arrangements. And it's all part of a sort of trying to enable taxpayers to deal with these things themselves. I think this has to be done by taxpayers rather than their agents. But in terms of self-assessment deferral, Neil, do you want to comment on that?
As far as I'm aware, there has been no deferral of that at all. There has been a deferral or a further delay in the surcharge for late payment of the 31st of January balance. Normally that would arise if you don't pay it on by 28th of February, but that's been pushed back to 31st of March. But I have not heard anything yet about the 31st of July payment being deferred. Last year, it wasn't announced until I think it was pretty much July before that was announced. So, you know, it could be late again this year. I don't know.
Thanks, Neil. Stuart, one primarily aimed at you, but others again may well pitch in. In what has been done in both directions, if you like, money out and money in, the balance between large and small businesses, and dare I be rude and say perhaps including in that micro businesses who might not even be members of chambers of commerce, more fool them. But if you want to comment on that, Stuart, as to how do you think he's got the balance? Is it working about right?
I can't say I've gone into the detail of exactly how this splits between various sizes of companies, but I suppose the argument around how the corporation tax rates will apply that Karen was explaining earlier would suggest that that 17 billion per annum that she was correctly highlighting will be coming out of corporate balance sheets after the rise in corporation tax to 23%. It is likely, therefore, to be coming out of the larger corporate balance sheets, which arguably are sitting with significantly higher levels of cash. I can't remember the exact figure. I think something like 110 billion pounds worth of cash sitting in corporate balance sheets that was considered to be raidable, I suppose. Whereas SMEs were generally much more exposed and tended to be much more likely to have debts accumulating on their balance sheets. So I think of the balance that that he's excluded the SMEs, the smaller, the 50,000 profit level SMEs from the increase in corporation tax, and that's got to be a helpful tipping of the balance towards SMEs.
Thank you so much. Sorry, Isobel? Yeah.
No, I was just going to say the 50,000 limit is pretty low, isn't it, compared to the limits that we've had for small companies' rates in the past.
And indeed, we
So-
have with numbers of employees, that kind of definition of small company as
Yes.
well has
Yeah.
been bigger than that. Listen, folks, I am very conscious of the time. It has come 3 o'clock. Thank you so much. Firstly, to my colleagues, particularly to my very temporary colleague, Stuart Patrick, from outside. We're very grateful indeed at Brodie's to him for joining us. We're very grateful, but we're also especially grateful to all the people who've participated, those who've sent questions. If you have other things that you need to ask, things that you need to pursue with any of the people on the screen or beyond, then please do so. We'd be delighted to take you on, to try you, and see what we can do to help you onwards. Otherwise, can I wish you a very pleasant rest of the afternoon? Thanks very much for attending. Bye-bye, folks.